Hi everyone and welcome back to Investor Insights. I'm Stephen, an investment advisor at iFAST Global Market. Today in the studio, I'm joined by Foong Chong Lek, Director and Head of Family Office at SGX, and Geoff Howie, Market Strategist at SGX. According to MAS, Singapore is the leading financial hub, managing over $6 trillion in assets under management as of end 2024. In this episode, we'll explore the latest trend, the companies coming to the market, and the opportunity this presents for investors. We would like to dive into how SGX new indices and initiatives are helping uncover opportunity beyond the usual blue chip stocks. Let's get started. Over the last few years, how has SGX evolved both in terms of new listings and how investors engaging with the markets?
So when it comes to the evolution of listings on SGX, it's really been a journey. And it's been about how SGX responds to the market demands because it's such a competitive market. The market wanted real estate and REITs. And therefore, in 1999, SGX came up with a REITs framework. Then we wanted to help encourage and develop fast growth companies. So SGX rebranded SESDAQ and came up with Catalyst in the year 2007. Subsequently, the market was interested in life sciences. Singapore had made lots of investment in the life science and the biotech industry, and we came up with the life sciences rules in 2009. Similarly, on the back of the commodities boom, we introduced listing rules for mineral oil and gas companies in 2011. Companies globally were starting to think about secondary listings on SGX because we're a neutral hub. So in 2014, SGX came up with a framework for secondary listing. And there's still more. When the tech market was hot and many of them were getting involved in SPACs, SGX came up with a SPACs framework in the year 2021. And finally, as you know, we've recently had a number of announcements from the MAS Equities Review Group, including changing some of the main board admission criteria and also the announcement of the global listing board or the listing bridge with NASDAQ. So it's really been a long journey and the market continues to evolve and SGX evolves along with it.
Yeah, so I think the secondary market has had a really incredible 18 months. When you look at the performance of the Straits Times Index, we've reached all-time highs. I think all-time high as of November is 45.75, and much of that has been on the back of research analysts upgrading many of the key component stocks of the Straits Times Index. But at the same time, you've had a lot of challenges externally on the geopolitical front, on the trade tensions and so forth. So I think a lot of investors have been kind of cautiously optimistic. And when you look at some of those flows, particularly net retail inflows and net retail outflows, a lot of the net retail inflow over the past 5 to 6 years has been more in times of distress in the market or more volatility. Case in point is, when you look at the net retail inflow to, let's say, DBS this year, half of it was in those first 2 weeks of April when the share price was trading at a volume-weighted average price of around $40. And then also, if you look at the whole 17 billion Singapore dollars of net retail buying since the end of 2019, most of it has been in terms of excessive volatility. And in times of when we were outperforming the world, as we did significantly in the year 2022, you saw less net retail buying then as well. And one other thing I think that's helped investors to articulate and to implement a cautiously optimistic strategy on the stock market has been the dollar cost averaging plans on the exchange traded funds. So if you're looking at a dollar cost averaging plan on the STI ETF, for instance, you're looking at around an 8% compound annual growth rate since the end of 2019. What's helped is, I've said, that volatility. So in October 2020, when their share price was trading at around $2.50, if you were putting $1,000 to work, you would have bought 400 units that month. But if that share price, or unit price I should say, gets up to $5, that same $1,000 will be buying less. And in fact, half as much units, only 200 at that time. So that's been a core component of our ETF investing that I think has helped investors to implement their trading strategy that is, obviously also playing to their risk profile of being and outlook, which has been cautiously optimistic. Also, I just might mention on the institutional flows, from a net perspective, the net buying, those sectors that tend to see more proportionate net institutional inflow proportionate to market cap, you tend to have been on the back of some pretty good economic tailwinds as well, like technology shares or industrial shares. And there's also been a little bit of moderate alignment with higher ROEs and higher net institutional inflow proportionate to market capitalization as well. So what that is inferring is that the institutional investors have still been going for growth and still been going for value into this year as well.
Hey, thanks for your sharing. I think it was pretty insightful. What kind of companies are seeking to list on SGX? Are we seeing more tech, healthcare, or sustainability-based player coming in?
I think yes, from all of these. If you look at the technology sector in general, I already mentioned AvePoint. It's an AI company that's involved in digital corporate governance. Then there has been NTT DC REIT. It's a data center REIT, but if you think about what's going on in AI, that's actually driving data center usage. So DC REIT is actually a tech play as well. There's others. There's Infosys Tech. That's a homegrown company. It's in software as a service as well, especially for SMEs. And there's even been a listing of a company called Meta Optics. So they do special lenses, which are used in technology. That's an A-star portfolio company. So these are the companies in tech that have listed recently. For healthcare, I think the listing that everyone is looking forward to is Ultra Green. They've registered their prospectus this week, and the expected listing is early in December. So they are in fluorescence, which is used for AI digital surgery. And I already mentioned China Medical Systems that listed earlier this year. When it comes to sustainability, let's keep in mind that sustainability is really a movement, right? And companies listed on SGX have had to mandatorily publish sustainability reports since 2016. That said, there's a number of industrial sectors which are closely linked to sustainability sector. For example, those in water technology, recycling, or environment, or materials. So we've had a number of conversations, and there are actually also mandated companies. So this means that a company has already mandated IPO professionals to do the IPO exercise. It's just that due to confidentiality matters, these haven't been announced yet.
So let's dive into specifically, SGX has launched the IH Next 50 and the liquidity weighted indices. So how does this help investors discover new opportunity beyond the usual blue chip stocks?
Well, I think I'll start it. I think the most important thing is we're profiling a group of stocks that have met selective criteria, that is standardized, and helps make those stocks more relevant to the everyday investor. And I think when you look at the underlying problem that we are trying to fix with our lower liquidity and lower turnover for recent years, is our stock market just has to be more relevant to everyday investors. And I think the great thing about indices is they do make these products relevant. And when they're productized, like the ETFs, it makes it even easier for investors to take that cautiously optimistic outlook and apply those indexes to their portfolio. I think I joke, and this is personally speaking, that those two indices, it's not that they're 50 constituents, but we actually need another 50 indices. So we need 48 more indices. And I think as the stocks become more relevant and liquidity is less of an issue, valuation is less of an issue, you're going to see some pretty amazing strategic themes or tapestry that makes up our stock market. And for us to be able to pull threads and make sure that we've got a decent group of stocks that are relevant to economic themes, or pivoting towards economic themes, or pivoting towards areas where they can unlock value, whether it's monetizing assets, whether it's pivoting to new industries, taking on more AI to be more productive and reduce their cost of equity, and also increase their return on equity. I think there's going to be a lot of toolkits, a lot of different avenues that companies can take in order to get to destinations where they might not have thought were possible in recent years. So I think the most exciting thing about the Next 50 index, it's the first of the development indices, and it's giving us a reason to basically profile a number of these key constituents to a number of investors who might not have had their attention in the past.
I'll add a little bit on that from a perspective of a retail investor, all right? So the index, firstly, the Next 50 index, it's based on market cap, which is size, and also the liquidity or turnover. So these are quantitative metrics. If as a retail investor, you're not actually tracking the market caps or the volume traded, if it's on the Next 50, then that means it's already past a certain threshold of market cap and liquidity. Then you could go to SGX.com website and you can go to the index tab and you can actually take a look at the Next 50 page and you can look at the component stocks so you can see the names. On top of that, you can take a look at who's on the reserve list and you can, the moment you see a name that you like, maybe you can do more research on that or speak to your advisor to find out more. So that's how Next 50 can help to highlight more opportunities outside of the blue chip index.
And also a number of those stocks being covered by research analysts at an increasing pace. GEM's research has been a really important core component of our revival measures. We first introduced it through the concerns of MiFID quite a few years ago. And at the moment, we're focusing on getting more research and more research providers on those small to mid-cap companies, as I mentioned, those stocks around 100 million to 10 billion. So if you look at your Next 50, you've actually got a decent amount, I think as many as 20 of the 50 stocks have seen research reports published on them, at least 20 out of the 50 just in the second half alone. And also, I think we've brought on something like 8 new research providers in the second half. So we're continuing to make sure there's enough research analytical material for the investors as well, because this is a really important part of them understanding all the insights they can on the stock, know the risks of the stock, and just become much better acquainted with it. So that prism or that lens that the research analysts give is absolutely pivotal to this as well.
I must say that with all the initiative and all the names that you mentioned, it helps to discover and create a lot more awareness of the hidden gems of the SGX listed companies. So how do initiatives like EQDP help to be SGX to stay more competitive vis-a-vis the Hong Kong and the US market that dominates investor interest?
Well, it's no longer just about macro, right? It's microeconomics as well. It's no longer just simply about paying dividends out of profits, but also paying dividends out of value realization, which is very different. So what I think many of us are really looking forward to next year, aside from a macroeconomic outlook, actually giving a microeconomic outlook for many of these companies. And these value unlock initiatives also enable the company to communicate much more clearer to the investors of what their intentions are, how they are going to move shareholder value to the central vertical of their corporate governance outlook, and really make a difference.
When it comes to EQDP, I mean, I'd like to talk a little bit about an upcoming IPO for Ultra Green. So if you look at the cornerstone tranche of the offering, so cornerstone investors, they get a large amount of shares, and they also lend their name in the IPO prospectus. And you can actually see the names of some of the EQDP fund managers in the cornerstone tranche. So Amova, AR Capital, eSpring, and Lighting Global. So this kind of suggests going forward, once the EQDP funds are fully deployed, these fund managers could also anchor or cornerstone other IPOs as well.
And look, the United States and Hong Kong is still very important. I just hope that investors will become more aware of having opportunities to the United States, for instance, through ST Engineering, which has been our best performing STI stock this year. Share price is up 80% so far this year, predominantly because research analysts have upgraded it by 70% as well. And then you've also got CSE Global, which is very important to the US, and you've got Jardine Matheson, Hong Kong Land, which is very important to Hong Kong. So those countries still very, very important, but we've also got stocks here that have exposure as well.
I mean, for this year, the Singapore stock market has done well. I mean, the share price has went up for many of the stocks. So other than the share price rally, do you see any other progress mix in different areas?
Yeah, that's a great question, because one of our, I guess, beachheads again that we really like to see is when our turnover basically outpaces the price. When you basically have more volume driving the turnover growth than price is actually driving it. And look, we've seen plenty of examples this year of things that you just full of promise for what's to come. One stock, for instance, Hiap Seng Industries, been with us for a long time. And in July, Chandri Astri, the Indonesian company, which is I think ultimately owned by Siam City Cement, increased its substantial shareholding from below 5% to close to 12%. Now, that strategic move for this company to expand across Southeast Asia basically saw this stock, Hiap Seng Industries, trade more turnover in the month of July than the entire preceding 10 years. Yeah, so there's plenty of examples of this. I mean, I wish we weren't in the predicament where we can see basically stocks being revived, in the case overnight or in the course of a week, and seeing sustained interest in the stock. But we're hoping to see and continue this. As we said, we're focusing on one SMID, small to mid cap segment of our stock market at the moment. Those 250 stocks above 100 million, but less than 10 billion, you've still got another 280, less than 100 million that we need to focus on as well. So as you say, breadth is super important for this process, and making sure we can source and originate volume, not just here at home, but more across the world. If you look at the examples of what Japan and Korea have done with their programs, number one message is it's really super important and the world knows what we're up to. I mean, everyone in the world pretty much now knows about this amazing waterfall at our Changi airport. I know it's not the same as that wonderful waterfall, but we do need to let the world know that we are working very hard to grow and harness our liquidity here in our local market.
Actually, one point to add is that there was a period whereby there was a lot of acquisition to take companies private, and that really shows the values that the institutional investor has on the Singapore stocks that maybe the retail investor didn't discover. I mean, they were all acquired at a premium. So from your perspective, what makes Singapore listed companies attractive?
Chong Lek's probably got a lot he can say about this, because he has a wealth of experience, particularly in ECM, where he has had to go around the world and actually relay much of what you said in the beginning about Singapore's outstanding economic credentials, where we pull well above our weight in so many areas. I mean, in terms of dividend distributions, for instance, we've been growing consistently and going to have another record this year again, and a real peripheral for Asia when you look at dividend growth in the recent 5 years or so. Buybacks are going to be at a 10-year high this year. So there's plenty of corporate action that is, I think, interesting enough, and then you combine that with our solid economic fundamentals, the demand for Singapore dollar, the low interest rates we've got. There's a pretty good, compelling case for Singapore as an investment destination.
Well, I can reframe the question. It's like, why do business with Singapore? And it's really about Singapore and its status as a hub. And there's a number of factors that drive that. For example, Singapore is a AAA rated country, so balance sheet is very safe. If you think about Singapore and living in Singapore, everything works, everything is smooth, the government runs very well, and it's such a friendly environment for living in, and especially for doing business in. And backed by that is, of course, the rule of law and the political stability. So these are some of the factors which promote Singapore as a hub, that naturally spills over into why companies and investors will pick Singapore.
Thanks, Chong Lek and Geoff, for joining us and for sharing your valuable insights on SGX listed stocks, the latest market trends and the opportunity for investor. If you'd like to learn more about investing in Singapore listed company or want personalized guidance on building your stock portfolio, feel free to connect with me. Thanks for tuning in, and we'll see you in the next episode of Investor Insights. Bye.